Welcome to The Explainer, where we break down the big stories hiding in the data. And today, we've got a real puzzle on our hands from the end of 2025. On one hand, the stock market was on an absolute tear. On the other, the economy was flashing some serious warning signs. It was a year of two completely different stories, and we're going to unpack both of them. So let's get right to it. How can the stock market look so good, so unstoppable, while a lot of economists are sounding the alarm? That's the big contradiction we're diving into today. We're going to look at that glossy, optimistic surface, and then we're going to explore the cracks that were starting to form just underneath. All right, first up, let's talk about the good news. This is the story you saw in the headlines pretty much all year. From a distance, the market in 2025 looked incredibly healthy. Just a simple, powerful, hot streak. And I mean, the numbers really did look great. The S&P 500 put up an impressive 16% gain for the year. And, this wasn't some flash in the pan. It was a sustained rally that kicked off in the spring and just kept going, notching its sixth straight month of gains by the time October rolled around. Investor confidence, at least on the surface, looked totally unshakable. So what was fueling this fire? Well, you can see the engine right here. The big drivers were sectors like communication services and technology. They absolutely soared, with gains over 23 and 21%. And the reason for all this excitement can be summed up in two letters: AI. The hype around artificial intelligence was just pouring fuel on the fire. Okay, but that's just the surface story. Now we're going to pop the hood and take a look at the engine. Because when you do that, a whole different, and honestly, a much more worrying picture starts to come into focus. That surface strength was hiding some pretty significant cracks in the foundation. And this, right here, is the heart of the problem. You see this huge gap? Stock prices were shooting for the moon, while the actual corporate earnings, the profits those companies were making, were barely getting off the ground. In fact, earnings growth slowed to its weakest pace in over a year. About a third of the market's entire gain came from what analysts call valuation expansion, which is basically just pure optimism, not actual results. This disconnect creates what you hear experts call stretched valuations. The market's forward PE ratio, which is just a fancy way of measuring stock prices against expected profits, climbed all the way to 22.5. Now, to put that in perspective, the average over the last 10 years is about 18.6. So in simple terms, investors were paying a huge premium based on the hope of what companies might do in the future, not what they were actually doing right now. And all of that optimism in the stock market, it was flying directly in the face of some pretty harsh economic realities. Take the U.S. job market, for instance. It just deteriorated, and fast. The average job growth absolutely collapsed, falling to just 29,000 by August. That's the weakest it had been since the pandemic. And this is that core conflict. The real economy was cooling down, while the stock market was still heating up. So you've got this hot market on one side and a cooling economy on the other. And this created a massive problem, a real dilemma, for the one group that has to try and manage all of this: the Federal Reserve. See, this dangerous cocktail of slowing growth and inflation that just won't go away has a name. It's called stagflation. And for a central bank, stagflation's pretty much the worst-case scenario. Why? Because the main tools you have to fight one of those problems usually make the other one worse. It puts the Fed in this incredibly difficult, almost impossible bind. What do? Do you keep interest rates high to try and crush inflation, even though you know it could cost people their jobs? Or do you cut interest rates to support the job market but risk letting inflation run wild? There is just no easy, painless answer. Well, in September, the Fed made its choice. They cut interest rates. And this sent a really clear signal to everyone that when push came to shove, they were more worried about rising unemployment than they were about that stubborn inflation. It was a calculated risk, no doubt, but they chose to prioritize jobs. Okay, so let's take a breath. We've got a hot market, a cooling economy, and a Fed walking this incredible tightrope. So if you're an investor, what do you do with all that? Well, let's take a look at the playbook that savvy investors were using as the year came to a close. One of the key strategies that gets really popular in a mixed-up environment like this is something called tax loss harvesting. Now, it sounds a little complicated, but it's actually a pretty clever way to find a silver lining, even when some of your investments are down. Here's the basic idea. Let's say you have one stock that did really well this year and another that, didn't. You can strategically sell the loser. That loss doesn't just vanish. You can actually use it on your tax return to cancel out the taxable gain from your winner. The end result is you reduce your overall tax bill. It's a powerful way to make your losses actually work for you. Now, there's always a catch, right? And this one's called the wash sale rule. Basically, the IRS figured out that people might try to game the system. So the rule says you can't just sell a stock to claim the loss for taxes and then immediately buy the exact same stock right back. You have to wait at least 30 days, or you can reinvest in something similar but not substantially identical. So what did this mean at the end of 2025? It meant that investors started hunting for stocks that had a rough year. Companies like Adobe and Lululemon, which were down quite a bit, became what you might call prime harvesting candidates. Investors could sell them, harvest that loss for tax purposes, and then get their portfolios set for the new year. And all of this brings us right to the finish line, the final days of December. With everyone trying to make sense of this confusing year and close their books, the market kind of just hit the pause button. It entered this distinct holding pattern, waiting for the calendar to flip to 2026. Trading volume just dried up. And I love how one analyst put it. They said investors are driving with the handbrake on. That's the perfect description. A lot of professional investors have already closed their books on 2025, and now they're just sitting on the sidelines waiting to see what happens next. And this year-end quiet is really all about uncertainty. Everyone is in wait-and-see mode. They're waiting for fresh signals from the Fed, they're keeping a nervous eye on geopolitical tensions, and they're watching for signs of trouble in big global economies like China and Japan. Nobody wants to make a big, bold move until the picture gets a little bit clearer. And so, that leaves us with the one critical question hanging over everything as we head into 2026. After a year of two completely different stories, which one is going to win out? Will corporate profits finally accelerate enough to justify these sky-high stock prices? Or will the hard reality of a slowing economy finally pull this whole rally back down to earth? That is the billion-dollar question everyone will be watching.